Hello, trading friends, and welcome back to Forex Focus, brought to you by IG. Going to take a look today at the recent GDP growth rate numbers in the U.S. and how major asset classes like the stock market and the currency market fared after this number, as well as some interest rate projections that are always interesting. But so far, just broadly speaking, this GDP number coming in right around expectations, another data point showing that the U.S. economy that is hopefully done with, well, depending on who you ask, done with its interest rate hikes. Inflation has calmed a little bit, but hasn't moved into deflationary territory, and GDP has calmed a little bit, but hasn't moved into negative growth or slowing economy potential. This number is another here in 2024 that's been able to strike that balance, leading to some pretty strong prices across the board, even though the stock market has fallen slightly here today, still very close to all-time highs, and that U.S. dollar getting close to its highs once again. But we'll dive into GDP, the number itself, in just a second. Let's start with the price action in the stock market. As you can see, just edging lower from these new highs, and depending on when you were looking at S&Ps after this number, S&P and NASDAQ and Dow were flirting with down 0.5% to a full percent, and then bounced back a little bit to essentially just be a slight reversal here midweek from all-time highs, but very, very slight. As you can see, very close to those all-time highs and still hanging in above $5,000, though the stock market did fall on the number itself, again coming in at a moderate number, right around expectations, still striking that balance whereby the economy isn't slowing, but it's not so hot that rate hikes are necessary from the Fed, which of course you'll remember moved the S&P and the NASDAQ and most major stock sectors lower back in 2022. But you are seeing this data start to gain some more traction in the currency world, as U.S. dollar has fought back to new year-to-date highs against Canadian dollar, for example, but it saw some strength across the board against Australian dollar, against Japanese yen, and a number of major currencies across the U.S. dollar forex pairs after this number, as the U.S. data continues to outperform relative to your Canadas or Australias or Euro area and what have you. And now this dollar isn't blowing out its highs for the last handful of years, but it's getting close to those highs that USD saw a couple of years ago, and depending on what pair you're looking at, is at year-to-date highs or close to it. And here, looking at dollar CAD, getting back above 136 is in that range of recent highs. And now let's take a look at the GDP number itself, because it came in at 3.2%, which is, in the grand scheme of things, a relatively normal number for the U.S. Anything in the 2 to 3 to 4% range has been normal when you take out some of the outliers, obviously around the pandemic, where we saw big negative numbers and then huge positive numbers in 2020 and 2021. This is a pretty normal number, but you have to add the context in here, which is the central bank here in the U.S., the Fed. Are they cutting, or are they staying, or are they potentially hiking further at some point in 2024? And so if you had gotten a number here relative to the expected 3.3%, that's what it was expected going in, if you got a number that was 4% or 5% or beyond, some of those high numbers that we saw in 2021, for example, then that would maybe indicate to the different asset classes that, hey, the Fed might need to hike again. This economy's still moving too fast, which actually might have been negative for the stock market. Now, of course, if you got a number that was 2% or 1% or in that negative territory, you would have thought, oh man, well, okay, they need to cut interest rates. That might be good for the stock market. But now we're moving lower. We're not growing in our general economy. And so striking that balance right around 3.2%, what was expected, still lower than expected, but right where maybe the central bankers want it, which is good, but not too good, so that they can normalize interest rates lower from 5%. In the grand scheme of things, might be a good best of both worlds number for both stocks and U.S. dollars. But let's take a look at what might be a more important data point moving forward, which is inflation. And of course, we have core PCE inflation and CPI inflation numbers on a monthly basis that'll let us know if this economy is, okay, still moving at a 3.2% GDP growth rate, but is inflation reined in? Is it getting closer to that 2% target? And this is another one that you kind of have to try to balance if you're the U.S. central bank and traders are, especially of the stock market, are trying to balance, whereby you might say, oh, well, we want a 0% inflation rate or a negative inflation rate. And so then the Fed can come in and cut interest rates. Well, if you're getting negative inflation, then the rest of your economy is probably slowing and not doing great. So stock market doesn't necessarily want that, but they also likely don't want a resurgence in inflation to 3, 4, 5, 6%, like we have seen, depending on the inflation measure you're looking at, because that would maybe necessitate another interest rate hike, similar to what we just talked about with GDP. And so we'll see if inflation can continue in line with the recent GDP measure to kind of strike that balance of headed in the right direction, but not moving in any crazy degree up or down, as they'll expect the U.S. core PCE inflation to come in around 2.8%. So continuing to stair step lower and not jump higher or move into deflationary territory too quickly. And of course, who's the middleman for numbers like GDP and inflation and the stock market and currencies? And that's going to be interest rates and the potential for cuts. And the market's still pricing in interest rate cuts likely in June. That's where right now there's about a 63% chance of that first cut coming in June. But there's still, the flip side of that, around a 36% chance that they don't do anything between now and then. And of course, you'll remember that the Fed was projected to cut maybe in March, and that looks like it's unlikely, or maybe in May, and that's less likely for sure now than it was a couple of months ago. And so they can move these odds around, but the Fed's still looking at potentially cutting in 2024, especially if the GDP numbers, the inflation numbers, and the employment numbers head in the right direction. But we'll see. Obviously, further strength might lift that U.S. dollar further, and further strengthen some of those numbers. It'll really be interesting to see how it affects the S&P 500 and the rest of the stock market. We'll see if these numbers continue to balance, and we'll see where the S&P and USD are going from here. Thanks for watching.